Yes, it is true that your ETF could be affected by the delisting of Chinese companies in the US. Hi guys, it's Eric from Hong Kong based in Germany. I've been investing since I was 17 years old for almost 20 years. I want to give you guys alternative perspective about investment and personal finance. The market crashed on the 11th of March when the SEC, the Securities and Exchange Commission, ordered 5 Chinese companies listed in the US to provide audit compliance proof by the end of March. If not, they could be delisted from the US exchanges as late as 2024. What's actually happening? Among the 5 names, including YUM China, which is the mother company of KFC and Pizza Hut. However, there are no big names like Alibaba or BYD, Xpeng and Nio yet. But given that they are also subject to the same regulations, I don't see any reason to justify why Alibaba, BYD, Xpeng or Nio not being delisted in the short future as well. Well, that's nothing to do with me, right? I'm just buying ETFs. I'm not buying ADRs, American Depository Receipts, which is like Alibaba, for example. That's not true. Why? Because out of the $37 billion worth of ETFs linked to Chinese stocks, 16% of them are invested in companies that might be delisted. And to be precise, 11% of this $37 billion worth of ETFs are invested in Chinese companies that actually do not have secondary listing, meaning they are only listed in the US but nowhere else, unlike Alibaba, Nio or Xpeng, which are listed in both in the US and in Hong Kong. Why is this important? One step back, ETFs, exchange-traded funds, they are usually index-based. They track an index. So for example, if I have a FinancePanda index that consists of 1 share of Alibaba, which is listed both in Hong Kong and the US, and 1 share of a company called B, which is only listed in the US. If there's an ETF need to track the performance of FinancePanda index, they also need to buy 1 share of Alibaba and 1 share of B. Now imagine delisting is happening. Alibaba is being delisted, but they can still raise funds in Hong Kong because they're also listed in Hong Kong. For company B is different. They're only listed in the US. If they're being delisted, they are cut off from the capital market, at least in the stock market. This will have a huge impact on the development and the finance of the company. Of course, the share price would go down much more in the company that's only listed in the US. There's also a second factor. For example, Alibaba, if they're being delisted, the index can simply switch from tracking their stock in the US to tracking their stock in Hong Kong. And the ETF would just buy the share in Hong Kong instead of in the US. So there would be still funds buying the shares of Alibaba. But for company B is different. The index simply cannot switch from buying their share in the US to buying the share in Hong Kong, because they're obviously not listed in Hong Kong. The share price will go down much more because they simply need to remove company B from the index altogether. And all the ETFs and funds that are tracking FinancePanda index would need to sell the share in company B. This would add even more pressure to the stock price of company B. That's why I say that it's very important to check your ETF. First of all, how many percentage of the Chinese companies that they are investing in the ETF, including companies that are listed in the US. And secondly, if they are listed in the US, are they also listed in other markets, for example in Hong Kong? Because if they're also listed in other markets, probably the impact of delisting is not as much as those only listed in the US. That's why I'm saying that it's very important for you to check your ETF portfolio. Look at your ETF, especially those focused on emerging markets, China or Asia. Look at the companies. If the Chinese companies that they are buying are listed in the US, then this is a red flag. And the second point is that if those Chinese companies are listed in the US, whether they are also listed in Hong Kong or other markets. So that if there's really delisting, then the impact will not be as big as those only listed in the US. Well, the last point is that some might argue the delisting will only happen after 3 years, because according to the law, only after 3 consecutive years that they do not provide the proof of audit compliance that they will be actually delisted. But you need to understand how the market works. If it comes out that they are being targeted to be delisted, even though it's not delisted immediately, the share price would go down a lot. We're talking about maybe 40 or 50%. This is not the situation you want to go through. If you guys want to know more about the situation of Chinese stocks in the US market, remember to subscribe and click the bell button so that you're not going to miss out. And check out my channel page so that you know the background information. Ciao!